Welcome to Inside with Savvy and Sage. I'm Rob Brinkman and Savvy Chad Tongo, my partner. So, Chad, do you like paying tax?
Well, as the good book says, give to Caesar what belongs to Caesar. That's my stance on it.
It does say that, doesn't it? Yeah. So today we're going to talk to a partner at I think they're the biggest tax law firm in the world, and they have a new idea for the successful business owner. And I have a lot of experience in the previous version, and hopefully we're going to get into that with Ken, because I think to understand the new strategy, have to understand the previous strategy. But it's pretty cool stuff, and we're really honored to have Ken, because this is, I mean, when I say this is brand new, I mean this is like a month or two. They just launched it in May of 2024, so we're going to be talking about something very fresh and new. So without more ado, let's bring on Ken.Kotch of Ryan Law. So Ken.Kotch, Ryan Law. Ken, you're working from your home office, but you're always on an airplane going somewhere. And the main reason is you've got a very interesting, I can call it a product, right? I mean, it fundamentally is a product, correct?
Yeah, I take no issue with that. It is a product.
Okay. So let's frame for the audience how we got to this new product by talking about the old product, right? Or the old tax strategy positioning that the IRS did not like, but let's just face it, the IRS doesn't like anything. So walk us through what captive private insurance has been. And by the way, you're the partner in I think Ryan is the largest tax law firm on the planet. Is that right? I mean, I think that's the case, right?
And I think that is correct. So we don't do any audit or attestation work. And on that basis, we're not in the same category as the big four. So if you exclude that element, we are the largest tax firm in the world. Yes, I do believe that is correct.
Yeah. Well, so Chad, you and I, Savvy, we have to be very impressed. I mean, we were impressed before, now we have to be very impressed. Okay, so give us the captive private insurance scenario before, which you and I have worked on this stuff. It is, successful high net worth people loved this program, right? So walk us through that, what the challenges were with it, and how you guys have pivoted to a new pioneering idea.
Sure, very happy to. So, hello to everybody in the audience, and for those that I haven't met, happen to be a tax attorney by license, but I've spent a lot of time in the world of risk management and alternative risk management. And captive insurance clearly falls into the alternative risk management category. So for those who aren't as familiar with the concept, I know you are very familiar with it, Rob, but by definition, a captive insurance company is a bona fide insurance company that, when properly structured, is respected for both tax and regulatory purposes. And rather than going out and selling insurance products to the general public, this type of captive or insurance company is set up for the benefit and at the behest of an affiliated entity. So it gives an enterprise and the stakeholders of that enterprise an opportunity to disassociate with the commercial insurance market to some degree and formally self-insure the risks that would be facing their own company. And, in the world that we live in, it's a continually dangerous, risky, litigious world. Not being a fear monger here, that's probably for another episode. But it's just a reality. This globalization, brings companies closer, and with that comes sometimes amazing things and sometimes scary and dangerous things. Not to mention,
and so this risk, these are not the normal risks that are lined up for the typical policy issued by the big insurer. So let's take an example that was one of the general risks that you would do with a captive or private, and that is key client risk, right? If you are 40, 50, 60% of your business come from one client and they leave, that's a huge risk. But the IRS didn't particularly look at it that way, did they?
They did not. So if we go back to kind of the origin story of that type of risk and why it might end up in a captive insurance company, there is no doubt in my mind, and I think if you polled 1,000 of your listeners, 1,000 would agree. Is the potential of losing one of your largest clients a business risk to your enterprise? Could it create business interruption? Could it create business disruption? The same way that a labor strike could, in a similar manner to how a tornado could. Yes,
Right.
it's just a different type of risk, but it certainly could have an impact on your bottom line as a business owner. Since the commercial insurance market is not really keen on covering that particular type of exposure, consider the major implications of losing a key customer that might be responsible for 80% of your annual revenue. From the commercial insurance perspective, they say, well, some of that, may be within your control, may not be within your control. You probably could find a boutique carrier to pick up that type of risk, but typically it's excluded or not even contemplated in the commercial policy packet. So what happens with a bona fide risk when it's not picked up or even considered in a commercial policy packet? The riskiness of the situation doesn't disappear. The risk or the exposure to loss ends up living on the balance sheet, so to speak, of the enterprise.
Yeah.
For a large enterprise that might be filing a 10K, they can take a reserve for such exposures that they're keeping on the balance sheet. Most of your middle market, albeit successful, I'm sure, listeners probably are not reserving on their balance sheets or accounting records for the potentiality of that type of loss, but it doesn't mean that it doesn't exist. Forgive the
Correct.
double negative there.
Yeah.
So what we try to educate our clients is given the fact that it's a bona fide business exposure, given the fact that it lives there on the balance sheet, we present the opportunity for the business owner to push that exposure off his or her balance sheet into a bona fide insurance company that they own. So when the commercial insurance market doesn't want to play, when it's a real risk of business loss, the captive insurance solution enters as an alternative from just sort of having a quasi savings account or rainy day just in case something bad happens. It allows the business owner to actuarially determine the potential impact of that loss or that peril. A licensed actuary will come in and price that according to market standard. And then the business owner has an opportunity to transfer that risk to their captive insurance company, along with a premium payment priced to market standard. And now the risk has been shifted out of the enterprise into the separate insurance company. It's a classic casebook example of where a captive insurance company comes into play. And not to anticipate your next question, either sage or savvy, but one might say, well, who cares, right? If you own the insurance company, you own the business, have you really effectuated anything of any consequence? And the answer is yes. When you've transferred the risk and the exposure into a separate insurance company, that insurance company provides certain asset protections that aren't provided for when you're bearing a risk of loss on your balance sheet. It's a separate legal entity. It has its own EIN. There are statutory protections around insurance companies that generally cannot be penetrated by creditors and predators. And it's very difficult to sue an insurance company and prevail unless you're an insured. In this case, there's only one insured. It's the original insured enterprise. There also happens to be a host of tax opportunities for insurance companies, both commercial and captive. And maybe we'll get into that a little bit because I heard you preview that topic when you mentioned the IRS previously.
Okay, so Ken, twice now you've used the word bona fide, right? So let's get down to why the successful high tax-paying clients like this program, and you mentioned they're writing a premium. So once they've identified these group of risks that they can address within their captive private insurance company, for instance, they could write $1 million check, right? And I don't want to go too deep in the weeds, but roughly half of that money has to be cured and available for claims to be written, and the other half can be invested. If 12 months goes by, then and there was no claims written, then that money that's been cured can flip over to the investment side. And now this high net worth person can be have allow this money to manage over time. You do this year in and year out, and I'm not saying you have to do $1 million every year, but you could vary the amount. But you could wake up 3, 5, 7 years down the road and have a pretty large pool of assets that can be accessed in certain ways. And that is really the appeal. And that also points to why the IRS didn't like this program so much. Is that a fair way of positioning it?
I think it is a fair way. So if we separate the branches of the federal government and we focus on one official branch, the legislative, and then we focus on an unofficial branch, sort of the clandestine fourth branch of government, U.S. Treasury, you'll see a very distinct disposition on the scenario that you described.
And Savvy,
So
just so
from-
you know, that's an attorney. That is the biggest slam, body slam, but said by an attorney that
Yeah.
all of a sudden you're like, it's kind of like somebody insulting your face that's British, right? And like, wait a minute, did they just insult me? And because you really don't know because of the British accent. So good on you, Ken. Good job.
Yeah.
Well, why, thank you. Coming from the sage, that's quite a compliment. If we look at it from Congress's perspective, Congress has spoken very, very specifically to the various favorable tax treatments of insurance companies in the United States from a tax administration perspective. So when we think of the IRS and we think of the Internal Revenue Code, it's Congress that makes the laws and the regulations that end up in the Internal Revenue Code. It's up to the IRS to really enforce those, not even necessarily to interpret them, but to enforce them. And as a general concept, just for the benefit of the listeners, everyone's heard of the Internal Revenue Code. Probably not everyone has actually seen a printed version of it. Maybe they've scrolled through a section here and there after a Google search, or maybe they have read it word for word. But I like to put things in perspective for those that don't have as much familiarity with it. So if you can picture the King James Bible sitting on your nightstand, it's estimated there's about 700,000 distinct words in that version of the Bible that we're all very familiar with. Consider that the United States Internal Revenue Code has 7 million distinct words in it. There's a lot of verbiage between those two bookends. Some of the regulations are very easy to understand. Some are very convoluted and ambiguous. But they all started somewhere. And the answer to that is they started in Congress. So when you give an example of, hey, $1 million of premium for a certain number of risks, there's a lot of people, I'm sure, within your audience that say, shrug their shoulders, say, spending $1 million to cover business risks, that may not sound like a lot. Maybe it does sound like a lot to some or to most. But I think from a public policy perspective, what Congress had in mind, in the same way that they are encouraging you and I as wage earners in the United States to do all we can to help fund our own retirement. There is Social Security. That's a whole nother podcast, I'm sure. But there are incentives built into the Internal Revenue Code. 401k is a very familiar one to most people. There's other examples of qualified retirement plans. It puts a carrot in front of the employee, in front of the taxpayer to say, look, if I just set aside some money to be responsible for my own retirement, there's a particular tax treatment that is more favorable than ordinary income. Maybe that's a tax deferral, or under the Roth, maybe it's a pay now and pay none later. But Congress has brought an incentive into the code to try to create a behavioral response for people to put aside more of their own money for retirement. I think that's incontrovertible. In the Internal Revenue Code, there's a subsection. It's called Subchapter L, which speaks to how insurance companies are taxed in the United States. Not the insureds necessarily, but the insurance companies themselves. There are very favorable tax provisions for insurance companies. When you look at the small to medium business arena, if you will, and you consider the fact that every day they wake up potentially with a new set of problems to deal with. And I know your audience can relate to this. There's this person who just resigned. There's that person that stole some trade secrets. There's flooding down in Houston. There's a global pandemic that shut us down for 2 years. There's a lot of risks within there that if they could just have set aside a reserve or some form of insurance, it probably would have helped them get through those unexpected events that aren't covered in their commercial policy packet. And say what you want about our legislature and our elected officials, but back in 1986, someone during the Reagan administration had the foresight to say maybe we should incentivize a set aside, particularly for the small to medium business owner, so that in the event that the unexpected does happen and it's not covered by the commercial insurance market, they don't have to dig into this week's payroll or their child's college fund to cover the new roof or to cover the business interruption from the loss of a key contract or client, as you mentioned, or the unexpected 2-year shutdown of a global pandemic, etc. So incentives were introduced for these sort of self-insured premium payments. One of the more notable ones is under a code section 831B. This has become the controversial lightning rod within the captive insurance space in recent years. But the provision was if you, as a hardworking businessman or woman, bring in a licensed actuary to identify insurable exposures that could lead to business interruption or business loss, and you set up an insurance company that's registered in a domicile and has a license to transact insurance, with an affiliated entity, i.e. the captive, as you set money aside in the event that one of these uncovered perils were to manifest, you would be allowed to take a tax deduction off of the books of your insured enterprise. And as the money goes into the captive insurance company, as an efficiency to build up the reserve and surplus in the event that you need it someday, there was no federal taxation on that corpus or that revenue or premium income to the captive insurance company.
Right.
Now you can imagine the IRS is starting to look that way and say, that's interesting. No federal income taxation on a corporation. Well, So it started off with a $1.2 million exclusion. The PATH Act was passed in 2015, and there was a provision within that omnibus bill to increase the exclusion of the 831B captive insurance company. They added about another million to it. It's been scaling up with inflation since, whereas today, to the point where today it's $2.85 million that is excluded from federal taxation in this captive environment. That is still on the books. I can show you that if I had a minute to share a screen. But the IRS comes in, as you said, they don't like it. Their posture on the situation is that it's a tax sham that's devoid of any economic substance or business purpose. The idea that they can sustain that argument after all of the losses that were realized and paid through captive arrangements during COVID, to me seems ludicrous. But nevertheless, they have identified some cases that were not structured properly. And we all know the old saying, bad facts make for bad law. And they've had a series of wins at U.S. tax court. Right. It certainly has cast a shadow against the industry. We find ourselves very much on the defensive now. But as we fight that battle, because again, Congress hasn't made the law go away. They could. It's just that the IRS doesn't like it. And in my personal opinion, and I'll stress that here in this public forum, in my personal opinion, Congress is trying to do the job. The IRS is trying to do the job of Congress. They're trying to quasi-legislate this away. Right. And that's unfortunate. But, when one door closes, another opens. And that's chapter 2 of our podcast today, I'm sure.
Sorry for the interruption, but this is our shameless plug that if you like the content, like the interviews, please subscribe. And what else should people do, Chad?
Thumbs up, like, and share on all your social media platforms what we do here.
That was really good visual. People are going to be very impressed with how you coordinated your hands with your mouth. That's great.
Thank you. Hand-mouth coordination.
And we'll get to that in a second. I just think the frustrating part is that I just think it's a bit disingenuous for this compliance body. Instead of just saying, look, we just don't like that you're not paying tax, they put a position out of, well, what you're insuring isn't real risk. And I'm sorry, it's just because an insurance company doesn't issue a policy doesn't mean that it's not a real risk, right? And the argument that I shared earlier with you is, if there's a county in Florida that just gets pummeled by hurricane all the time, and the insurance companies just simply say, you know what, we're just not going to insure anybody here. So you can't buy a policy if you live in that county. But does that mean that that's not insurable risk? I mean, that's kind of that's the argument the IRS is trying to get us to accept. But at the end of the day, it's like jousting with windmills, right? I think that's a fair analogy as well. So you all have taken the existing law in the book, and you come up with a new, different approach, which devastates the argument of real, bona fide insurable risk. And so, why don't you jump into that program?
Sure, very happy to. So we have brought forth to the market a program called Repaid, RE-paid, PAID. And the thesis statement behind Repaid is as follows. We still firmly believe that every business owner has the right to push those exposures that we talked about off their balance sheet and into a captive insurance environment. But until we get a more secure foothold in this ongoing battle with the IRS, we're putting that program into a form of dormancy as we continue to advocate on behalf of our clients and behalf of the industry. And just as you said, if the IRS is taking umbrage with the fact that these aren't real risks and therefore not insurable, and I absolutely agree with your posture, Rob. They oftentimes will put forth a loss ratio standard to say if you don't have a 65% loss ratio in a particular line, it's not really insurance. That's in fact one of their proposed regs that's floating around out there, which just, again, seems very ridiculous to me. So consider cyber exposure, which is not too many years ago that would have sounded like sci-fi. Now it's a daily occurrence and a daily concern. Imagine having to prove that for every dollar you've put away over the years, 65% has become a claim of loss. In other words, the IRS is trying to base an argument that prior experience is dictating whether it's truly insurance today. A lot of the clients that I work with, particularly in the small to medium business community, haven't had a cyber event. And thankfully they haven't. That doesn't mean that they couldn't in the future. It doesn't mean they're not preparing for it today. Therefore they're putting these insurance programs in place. But to say that you have to prove that you had a 65% loss ratio prior for it to be a real risk exposure, it blows my mind. And I see Savvy shaking his head because he probably knows the reality of such things. It could be extremely high severity, but a low frequency type of exposure. And that's what people are trying to avoid, of course.
Yeah.
Okay. So back to Repaid. What we decided to do as we sat down to re-architect our captive insurance offering is to say, if that's where the IRS wants to attack, well, then let's start with only lines of commercial insurance that are commonly accepted, and even the IRS, with as much gusto as they want to put behind it, would never be able to argue that it's not quote unquote real insurance.
Right.
So we've limited our program to areas of general liability, commercial property coverage, commercial auto coverage, and workers' comp. And we are not asking our clients to cancel their existing coverage and put it into their own captive insurance company. We are asking our clients to continue business as usual. Focus on growing your business. Focus on instilling within your employee base the proper risk management behaviors to try to minimize losses and things like that. Focus on the things that you have to focus on as the CEO, CFO, COO of your enterprise. And let's start to re-examine how you're handling your commercial insurance buying cycle. So at the beginning, how does commercial insurance work? You typically will bring in a licensed insurance broker who will consult with you to identify the risks that will ultimately be placed into the commercial insurance market, i.e. an insurance carrier. That insurance carrier is very likely to further reinsure the economic impact of those exposures to a reinsurance syndicate like Lloyd's of London. And that's generally how the cycle works. We are here to augment that cycle, not necessarily to disrupt it. It's really to add a step sort of at the end that will provide an economic benefit to our clientele. And the way that that works is we're still creating captive insurance companies for our clients, but we're working with carriers now who are willing to work with the brokers of record that our client is already using. Oftentimes, the real relationship is at the broker level. It's not necessarily, I've got my brother-in-law works at Chubb, therefore that's the only carrier I'll use. It's more my brother-in-law, works at Marsh, and that happens to be our commercial insurance broker, or something along those lines. So we still work with the client's current insurance broker. However, we introduce that broker to a series of A-rated commercial insurance carriers who, rather than sending a tranche of that risk to the reinsurance market, i.e. Lloyd's, along with a reinsurance premium payment, they are sending that tranche of reinsurance and a premium payment to the captive insurance company owned by our client.
Got it.
I know this might get a little convoluted in radio land, but the process is as follows, and then I'll turn the mic back over to the two of you. We are in a hardening commercial insurance market right now. What that means is rates are going up even if your losses haven't gone up as a business owner.
Right.
So we have clients that in some cases are facing 2x or 3x of the premium levels that they were experiencing 2 to 3 years ago on the same property with the same exposures and the same loss ratios. It's become a very difficult reinsurance market for the carriers. There continues to be very devastating sort of climate-related events, political disruption around the world. It's an election year. So anytime there's uncertainty, it tends to drive insurance costs up. And that's what's happening now. So we might be working with the client who says, geez, I haven't had any more losses than I've been experiencing for the last 10, 15 years, but my insurance rates have gone up to this level. Let's just say it's gone up from 800,000 to $1 million, to stay in that $1 million example you provided before. We cannot affect that $1 million quote that they're getting at renewal. That's a market-driven third-party quote. That's what the market is bearing. However, if the broker and the client is willing to have the same, or are willing to have the same risk brought to a different A-rated carrier, we'll introduce that carrier to the scenario so that if that same insurance is placed with this A-rated carrier instead of the former, this new A-rated carrier will agree to indemnify the client for a certain amount of risk. And if the client is willing to take on a level of risk, oftentimes greater than their current deductible layers, but still with a cap that I can explain some details, they will be in receipt of a reinsurance premium payment, which can be as much as 50% of their overall spend. So the net of all that is they get the same coverage. They are taking on some more risk in the captive insurance company that we've created for them. But on that $1 million spend example, they would have $500,000 of that coming back to their insurance company, enjoying the underwriting profits in good years, maybe experiencing underwriting losses in bad years. But it shifts the dynamic of just sort of giving that money away, never to be seen again. It brings the money back into their enterprise by the affiliated captive that we create.
Yeah. So an analogy here is that when we moved from Connecticut after being up there for a really long time, to go back to State Farm and say, hey, been paying you guys premiums year in and year out for a really long time. Never submitted a claim, ever. Now we're selling the house. Hey, how about a little kickback? And they just kind of laugh at you, right? Well, why would we do that? And so that the situation here is that the same dollar out the door is not changing, right? You're paying for the same quality of insurance. You might be taking on a little more risk, but you have a profile of clients. So if a client's already has a lot of claims history, they're not a candidate, at least today, for this. Is that a fair statement?
It's a fair statement, Rob. So really we're putting our clients in the position of of the insurance company. So if they're experiencing a lot of losses, many times no fault of their own, just they happen to be where tornadoes land, or they happen to be where hurricanes show up, or they happen to be in a union state and there's labor strikes all the time, or whatever it is. If they're experiencing a lot of losses, or they've received more in claims payments than they're paying in premiums, why would we want to put them in a loss position? So on that basis, you're absolutely correct, Rob. We're looking for clients that typically have 40% or less loss ratios in those areas of coverage I mentioned: general liability, work comp, the commercial auto, and the commercial property.
Yeah. And not to put too fine of a wrapper around the amount of insurance premium, but generally this starts making sense once you're above 250,000 a year.
That's exactly right.
Yeah.
In any of those one policy lines, sometimes we can combine like auto and work comp, but generally speaking, that's absolutely correct, Rob.
Yeah.
Is that 250,000 on insurance premium spend or income?
Yeah, that would be on insurance premium spend, Chad. So great question. As they look at their insurance premium bill from whomever, same, ABC Co. If they're spending 250,000 or more in any one of those areas, they would have that box checked as a qualifier.
Right.
Is there a particular jurisdiction or state that would make this type of product more difficult to implement in comparison to, other jurisdictions?
Yeah, that's a great question. So, given the fact that we're working with A-rated carriers that are admitted in all 50 states, it's really not an issue, Chad. Of the 4 policy lines that I rattled off, as you probably can imagine, work comp is one of the more heavily regulated areas of insurance on a state-by-state basis. But again, the carriers we're working with are already admitted in those states, and as Rob pointed out, are deploying the same architecture, just with a different reinsurance facility here. As far as where the captive is set up, there's 46 different states now that allow for captive insurance formation. You can have an operation and an insurable interest in a state that's distinct from your captive licensing. So in other words, the same way you could be incorporated in Delaware, but operate in Chicago and St. Louis and Tampa Bay, oftentimes captive insurance is set up in a similar fashion.
Yeah. So you guys are playing nice. Before we started filming, Ken, why don't you turn your camera and show what made Chad balk, because he's a USC Trojan. So show what. Yeah, go ahead, do it. Do it.
All right. So I don't know if there's any Arizona Wildcat fans
there
out
you
there.
go. See, so yeah. So speaking of arrows and spears, I thought you guys were going to go at it right here, but fortunately you're separated by a camera, so that's a good thing. So Ken, for let's say it's someone who's writing those kind of premiums, doesn't have a lot of at least historical risk. This when it's called repaid because
we are paying back the insured, and they get rewarded for good risk behavior.
Yeah. So again, kind of like the first program, there's a curing period. And I think that curing period's at least 12, if not more, like 18 months, right? But
that's correct.
Right. If you're writing these checks, and it's the same check you're writing from one carrier to another, and no events occur, and let's say, just to keep it simple, you did write $1 million check, you're going to get something back between, I'll just pick a number, net of fees and so forth, somewhere between $200,000 and $500,000, somewhere in there. And so that's money that you're putting back in your pocket that in the past, once you wrote that $1 million check to Chubb or the Hartford or to Marsh or whoever it is, it's gone, just like my State Farm analogy. So this at least gives the business owner an opportunity in this difficult economic climate to put some dollars back into the corporate coffers.
Very well put, Rob. And just as a footnote, not a correction in a way, they get to do that every year. So if we find ourselves in a softening market and premiums go down, and the client says, "I'm just not going to do the captive reinsurance side of it this year, so be it. They can take a pass. But given the current climate, as you mentioned, that is going to be an annual opportunity for them.
Yeah, yeah. So somebody's seeing this, they're going to reach out potentially to their insurance broker, right? How many insurance brokers out there are aware of this, do you think?
I don't think very many. So, to my knowledge, it's the only program like this in the United States, to my knowledge. It took some time to get the carriers on board. We are now endeavoring to educate more brokers around it. So, we're open for business and always enjoy conversations with brokers to see if there's anything in a blind spot we might have missed, but also to enable them to have another tool in their toolbox, so to speak, so that they're longstanding, trusted, and very sort of relationship forward, clients that they've been working with for so many years. They can at least bring some form of good news to the table come renewal. Just again, given the hardening market that we're in.
Right. So whether it's a client or a broker, how do they reach out? What's the best way to connect with you?
Sure. So I'll share my email and I'll share my cell phone number. People are welcome to call me on the cell.
We'll put it on the screen as well. So
all right. Yeah. Very good. So ken.kotch, ken.kotch @ryan.com, and cell phone number 602-326-3022. Happy to respond to live calls or texts.
Yeah. And so, and I have your text. You and I text and call frequently. So, we live in the same neighborhood. We play pickleball together. And it's funny. We have, I said this earlier, that I'm like the big brother you never wanted, right? Because things change when we're out in the pickleball court. Because I want you to get better, Ken, but you fight me on the two-handed backhand. Why do you do that?
Oh man, where's that? Where can I type in an expletive here?
we can add it as a visual.
Bad habits from ping pong.
Yeah.
Well, I mean, for the record, Rob is an excellent pickleball player and actually a really good coach as well, and really a good person. And so is Chad. So I was trying to come up with a lighthearted response, but all the guidance and mentorship is much appreciated, Rob. I only can apologize that the skills haven't improved, to the level that you'd expect.
Well, look,
and for the record, I don't play pickleball like Ken and Rob. So I play ping pong. I beat Rob once at his house. So, I mean, that's something to put on my shoulder.
Yeah. So I have a ping pong table in our house, and, it's just like, it's kind of rude actually to have somebody come over and destroy you. It's just not rude. So we will never play again. So that's the way it is. Yeah. All right. So Ken, you're a good man. This is cool stuff. And I know it's technical. But when you're talking about this kind of financial impact, technical is just part of it. It's part of the process. So we appreciate you coming on today, and Godspeed with it. I think you're going to do great.
Well, thank you. I really appreciate the platform to share it with your audience, and best of luck to the two of you. I know you've got a lot of exciting things going on as well.
Yeah, great. All right. Good to see you. Thank you.
Thanks, Ken.
All right. Thank you.